Good morning and good afternoon to everybody, and thanks for joining us. I'm Krista Hughes, and I'm pleased to welcome you to today's media conference about the BIS March Quarterly Review. With me today is Claudio Borio, Head of the Monetary and Economic Department, and online we have Hyun Song Shin, Economic Advisor and Head of Research, and we have the authors of the special features. Before we begin, I'd like to reiterate that only the comments from Mr. Borio and Mr. Shin are on the record. Any author comments are off the record, not for quoting or attribution. And this media conference will be recorded and published on BIS digital channels next week. And the embargo lifts, as I think you all know, on Monday at 1 o'clock Central European Time. Mr. Borio and Mr. Shin will give some introductory remarks, and then we'll open the floor to questions. We'll take questions first on the overview, which covers the period from the 25th of November to the 17th of February, and then on the special features. So we'll now start with the introductions, and Claudio, over to you.
Well, thank you. Thank you so much, Krista. And thanks to everyone for joining us today. I will speak about the period under review and also about some more recent developments, as these tend to underscore how markets are converging on the narrative of central banks. Once again, during the period under review, market movements were shaped by perceptions of the future path of monetary policy, as central banks continued their fight to reduce inflation and achieve price stability. During most of the period covered in the quarterly, investors saw inflationary pressures weaken. They expected that central banks would end rate hikes in 2023 and cut aggressively in 2024. This led to a general easing of financial conditions, which supported valuations across many market segments. Importantly, the sanguine attitude of investors contrasted sharply with the cautious tone of policymakers. Central banks gave no indication that monetary easing was on the horizon, as inflation remained high and many labor markets tight. In early February, renewed evidence of strong labor market conditions and solid growth nudged investors to bring their views more in line with those of central banks. Market prices in recent weeks reveal that investors revised their inflation expectations upwards, along with their projections for Federal Reserve and ECB peak policy rates. They also pushed further out the envisaged timing of rate cuts. As a result, financial conditions tightened markedly. Risky assets lost much of their gains from December and January, and the dollar regained its strength from early December. The longer market participants delay acknowledging the tightening stance of central banks, the higher the likelihood that buoyant valuations would keep supporting inflationary pressures, and therefore that at some point we would see an abrupt financial repricing. Thus, the recent narrowing of the gap between central banks and markets is welcome. But not all has changed. Some other general features of the financial landscape of the past 3 months are still very much with us. The view of market participants that the outlook for inflation is benign kept a lid on nominal core bond yields for most of the period. In this context, sovereign bond market tensions in Japan stood out as investors reassessed the yield curve control policy. Broad-based interventions by the central bank, including this week, smoothed market functioning. Spillover to other markets have remained limited. Reductions in perceived risks led to gains in risky asset markets. Stock markets rallied as investors' compensation for risk declined, despite a subdued earnings outlook. Likewise, lower default risk underpinned narrower credit spreads and helped to revive debt issuance. In contrast with this general picture, bank lending was weak in major advanced economies. China witnessed a string of positive economic news after the country reopened. While portfolio inflows did not return, China's equity market was reinvigorated, and bank lending grew at a fast pace at the start of this year. In emerging market economies more generally, financial conditions moved in tandem with those in advanced economies, easing early on and remaining broadly stable thereafter. Against the backdrop of resilient growth and falling inflation in most regions, EME assets generally performed well, but remained sensitive to the ebb and flow of the US dollar. And with that, I'll now give the floor to Hyun, who will talk about the special features in the quarterly.
Thank you, Claudio. Hello, everyone. Let me describe special features in this quarterly review and two boxes. The box by Ben Cohen and Kevin Tricole examines the fluctuations in model-based derivative margins, both during the market stresses in March 2020 and during the gilt market stress episode last year. The authors show how a larger precautionary component can help smooth the fluctuations in margins and thereby mitigate deleveraging. In the first special feature, Frédéric Basset, Claudio Borio, Cristina Leonte, and Ilyok Shim examine how monetary policy and prudential policy interact. The authors find that monetary policy tightening is more likely to usher in financial stress when debt levels are high and there have been large recent rises in inflation. Conversely, prudential policy tightening, whether before or during a monetary tightening, helps to reduce the likelihood of financial stress.
The second special feature is motivated by how commodity prices and the US dollar both rose last year, whereas historically they moved in opposite directions. The authors, Boris Hoffman, Tae-Jin Park, and Albert Pierre Tejada, find that the conjunction of commodity price rises and dollar appreciation increase the risk that commodity importing economies experience growth and high inflation, and that this effect is larger for emerging market economies. In the third feature, Sally Chen, Eric Zhang, and Lian Chang examine global value chains during the COVID period. They find that the number of links between firms fell and was slow to recover, but that shipment along existing links rebounded swiftly. Meanwhile, stock prices fell more for firms with cross-border links to customers or suppliers in countries with lockdown announcements. Brian Hardy and Sonia Zhu draw on the BIS international banking statistics and other data to revisit the bank sovereign nexus in the COVID period and how it was affected by central bank asset purchases. While sovereign borrowing surged globally during this period, only banks in emerging market economies steadily increased their holdings of sovereign debt. In advanced economies, central bank purchases reduced such holdings of banks while boosting banks' holdings of reserves. Bank and sovereign credit spreads are more closely linked when banks hold more sovereign debt. Similar findings emerge in a box by Bettina Farkas, Ulf Leverick, Thomas Sansti, and Nikola Tarashev, who draw on data from the International Association of Insurance Supervisors to shed light on the link between insurers and sovereigns.
Thanks, Claudio, and Hyun, I hope that we can sort out the technical difficulties so that you can join us during the Q&A. So now we do turn to questions. James McIntosh, please go ahead. Thank you.
Hopefully you can hear me.
Yes, we do. Thanks, James.
Excellent. I was interested in to what extent you saw any breakdown in the link between market participants' expectations of central bank action and particularly the equity markets, where there seemed to be a bit of a disconnect, at least for a couple of weeks, that got quite large as real interest rates rose and stocks carried on up as well, which was sort of reversing what had been the general pattern last year.
Well, thank you for the question. Well, more generally, I would say, as you know, we have this a box in the QR that looks very closely into the relationship, what is driving equity prices, and it looks at two factors. One is the discount factor, which includes a premium for risk and earnings, so cash flows and the discount factor to discount those cash flows. And the bottom line of the piece is that indeed we see that the key factor that has been driving the perceptions of the valuations up has been not so much the interest rate per se, but the risk component of the discount factor, which has been falling, just that at the same time as earnings have been relatively weak. Now, the bottom line of this is that equity valuations are particularly sensitive to adjustments in the perceptions of agents of future risk and also, of course, risk attitudes.
Okay, nothing further to add from Hyun. Thank you. Philip Inman from The Guardian. Please go ahead.
Hello, can you hear me?
Yes, we do.
Yep, great. Thanks very much for taking my question. So I wondered if I might ask you, how do you think central banks in developed countries, I'm thinking of the Fed and the Bank of England, the ECB, and the Bank of Japan in particular, should consider the prospect of a return of high energy prices next year? By which I mean, is it possible that all the current predictions for inflation falling quite dramatically towards the end of the year and beginning of next year could be a false dawn? And I wondered how you thought they should consider those risks. And just as a supplementary, the prospect of some governments having some fiscal space, do you think that they should be using that fiscal space and potentially putting extra pressure on central banks to raise rates further? Or do you think those fiscal authorities should be restraining themselves and lowering their debt? Thank you.
Okay, so let me take the two questions in turn. First, the first one about what might happen to commodity prices going forward, and the false dawn question. Well, clearly, no one has a crystal ball, and all monetary policy is about risk management. Always trying to assess whether the risk of doing too much is greater than the risk of doing too little. And in this context, I think the attitude of central banks, which has been very cautious, is appropriate. I mean, what they don't want to do at all costs is to repeat the stop-go policies of the 1970s, when you were reversing and then you realized that the job had not been done, and then you had to go back, and so on and so forth. And this really is what has been underlining this disconnect, or this gap between financial market perceptions and central bank communication. So central banks have been very, very clear that at this stage, what's the most important aspect is to get the job done and to be cautious about declaring victory too early. And indeed, what we have been emphasizing in our work is that it might be easier to get inflation, or it should be easier, it's more likely to be easy to get inflation from 8 to 4 when most of the work is being done, for example, by commodity prices and the like, and then to get it from 4 to 2, which central banks will have to do going forward. Because the longer inflation persists, the longer its impact, so the harder it's going to be to bring it down. So, to summarize, a cautious attitude designed to make sure that one is not declaring victory too early is the appropriate one. As regards fiscal policy, we have emphasized repeatedly that what's absolutely essential is to ensure that fiscal policy follows a sustainable path. One of the things that we have been concerned about, that we discussed in the annual economic report over the last couple of years, is that before the inflation surge, we had reached a situation in which government debt levels globally were at historical highs. And because interest rates were at historical lows, as you know, in some cases even negative in nominal terms, quite apart from being negative in real terms, then the debt burden had never felt so light. So this meant that because also monetary policy would have to sort of normalize at some point, there would be tensions between governments and central banks that could arise. And what we're seeing now is precisely that, because central banks have had to tighten in order to bring inflation down. So to summarize again there, it's extremely important that central banks keep their fiscal position sustainable, and that will reduce the tensions with monetary policy.
Thanks, Claudio. And Hyun, shall we see if
Can
we get sound?
you hear me in the room?
Yes, we can
Excellent.
now.
Excellent. Thank you, Philip, for that question. Just to add to what Claudio said, I think one of the sort of underlying questions, you didn't put it explicitly like this, is will everything go back to the pre-disinflationary period, and will we have very high inflation back? I think certainly a rise in food and energy prices would impact headline inflation. But remember that a key aspect of what happened, and one of the key gains, if you like, in the last few months has been the cooling of the labor market, in particular in the US. So we've seen, vacancies come down relative to, relative to the working population, and relative to the unemployed in particular. So that the beverage curve, has shifted down, and that's something that will be there irrespective of what happens to food and energy prices. And to the extent that, of course, we're interested in core inflation, the inflation in services will be a very important component of that. And so, just looking at the impact on headline inflation from food and energy prices, will not be it. And I have nothing more to add to the fiscal question. I think Claudio addressed that very well.
Thanks. And now we'll go to Maureen Khan from The Times. Maureen, go ahead, please.
Hello?
Yep, go ahead.
Thank you. Okay, great. Thank you for taking my question. Can I ask about, so your sort of long-standing position that it's better for central banks to over-tighten than under-tighten. How does that relate to the long and variable lags in which monetary policy operates? We've heard maybe a few more central bankers talking about having policy in the pipeline, which means the full effect of their rate rises has not been felt on the economy yet and may take up to 18 months to do so. And could you also speak about the findings in one of your bulletins today about the sensitivity or the declining sensitivity of demand to interest rate rises? Why has that happened? And is that also one of the reasonings that you can say for why it's better to do more, if in case it seems to be the case that doing more is having less of an impact on demand than it would have had in other historical periods? Thank you.
Let me start with the second question. We have not actually mentioned anywhere that we think that the response of aggregate demand to interest rate rises has changed or indeed has declined. I mean, there are arguments to suggest that, if anything, the opposite is the case, because we are facing a situation in which interest rates have to rise in the context of unusually high or historically high debt levels. But at the same time, there have been changes in the composition of that debt that may have reduced or at least partly offset that component, that part of the transmission mechanism. Now, on the lags, it's clear that one reason why central banks have been moving more cautiously after having raised interest rates quickly is precisely that one also needs to assess how much what the impact is going to be of the policy rate increases that have already taken place. And there, as always, uncertainty about the precise impact. Economists like to talk about long and variable lags, but there may be questions as to whether those lags may have become shorter now that financial markets have become so important in driving economic developments, and that central banks have been more open than they have been in the past with their communication. So the bottom line here is that indeed central banks are aware that they have to take into account the lags over their previous tightening, that they're watching that, and that is indeed one reason why they have become more cautious about their next moves, and they're waiting. They become even more data dependent than they were at the beginning.
Thanks, Claudio. And just for everyone's awareness, the bulletin that was referred to in the question, we can put the link to it in the chat. It was entitled Private Debt, Monetary Policy Tightening and Aggregate Demand. And I think Hyun can speak to that aspect of the question. Thanks.
Thank you, Krista. Thank you, Maureen. Actually, that is the question on private debt. I think Claudio already addressed. Let me go back to Maureen's question on the long and variable lags and why over tightening might be more prudent than under tightening. If you look at the historical experience in the 1970s, what you see is that inflation isn't a single peak phenomenon. There are quite a few ups and downs, and I think those were episodes where you saw inflation coming down momentarily, but then it picked up again as new shocks materialized. And I think the reason why central bankers have been emphasizing going the last mile in bringing inflation down to target is precisely for the reason that once you're not fully back to target and then you relax too early, you can open the door to a renewed increase in inflation, which will undo much of the good work that had gone before. Now, clearly, that has to be balanced against doing too much. But as you also alluded, one of the things we find in this bulletin is that the sensitivity of demand with respect to the policy rate, has somewhat moderated. And one of the reasons might be that during this long period of low interest rates, one of the things that's happened is that household debt, private debt more generally, and in some ways, especially corporate debt, has lengthened in maturity. So unless you have long-term rates really jumping around, shifts in the policy rate tend to have less of an effect. So that's one of the hypotheses. Of course, we will need to do some more work on precisely why. But it certainly does seem that there are some mitigating factors here that mean that even though debt has increased, the vulnerabilities may be somewhat low.
Thanks, Hyun. And now we'll go to Bastian Benrath from Bloomberg. Bastian's on the line. Please go ahead.
Yeah, hey, thanks so much for taking my question. So I have two questions. First one would be very general. Where do you judge leading central banks of the world to be in their fight against inflation? Do you think they're now ahead of the curve, or are they still trying to follow the curve, so to say? And in addition to that, how long will central banks need to hike? And my second question would be, how is your perception of market expectations? Do you think market participants will project monetary policy moves more accurately in the remaining year, or do you expect much more market turbulence coming down the road? Thank you so much.
So on the first question, clearly central banks were surprised by the strength and persistence of inflation initially, and that is why they have responded so forcefully subsequently. So effectively now they are in a position, as I was mentioning before, that they can slow down the pace of adjustment as they have, and then try and assess also with more leisure, if you like, the impact of their own policy so far. But as I said, the most important thing at this stage is not to declare victory too early. As regards market participants' expectations, as the QR stresses, there was a gap. Now, the gap is not, has its own risks, because, as I mentioned in my initial remarks, the longer it persists and the wider it is, the more financial conditions will be offsetting what central banks are trying to do, which is effectively to constrain aggregate demand. And therefore, also, the greater the likelihood that should markets prove wrong, at some point there would be a repricing, an abrupt repricing, which is why the fact that now markets have been moving closer to central bank perceptions of their outlook for their own policy, this is a welcome development.
Thanks, Claudio. And now we have a question from Mark Jones of Reuters. Mark, can you go ahead, please? Mark, we don't hear you.
Yep, sorry about that. Hi. A couple of quick questions. You just were saying at the start of it, central banks should avoid this kind of stop-go idea that we saw in the 70s. Does it matter if they slow and then re-increase the pace at which they hike? Is that not the same thing? Are you basically just talking about stopping for a while and then restarting being the real issue? And also the second question is, today's the 1-year anniversary of Russia's invasion of Ukraine. If you were to look across markets, what would be your main takeaway from it, and where are the kind of impacts that have lasted, or alternatively, are you surprised how short the impact actually seemed to be when the events unfolded?
So let me take the first question, and I guess there are many ways in which the second can be answered. But as far as the first one is concerned, as you know, there are basically three issues that central banks have been grappling with. One is how fast you change, you tighten. The second is how far you go, the issue of the terminal rate, and the third one is for how long you stay there. And I think central banks have already answered the first question. Now they're grappling with the second and the third. There is nothing wrong with central banks sort of slowing the pace of increase and then adjusting it, possibly having to speed it up again, because that's what policy is. Policy is data dependent, and there is no way in which one can anticipate the future. So it is important for central banks to, along this line of making sure that they do not declare victory too early, but along this trajectory, they remain flexible to adjust to changing circumstances. On your second question, I think that probably the more important aspect of that question, and I don't know whether Hyun would like to take another one, is where there could be fragilities or vulnerabilities in financial system and in financial markets, not just as a result of the war, but more generally as a result of the broader economic landscape. And there, I think that it is a point which is worth re-emphasizing, that indeed what's special about the current situation is the conjunction of high debt and monetary policy tightening, and we may come back to that in the discussion of special features. But that a good piece of news in all this is that the financial system, within the financial system, banks are much better capitalized than they were in the past. Whereas where there could be vulnerabilities, where there can be vulnerabilities because of hidden leverage and because of hidden maturity mismatches, is in the non-bank financial intermediation sector, which has grown in leaps and bounds since following the GFC. Now, part of that growth was fully intended, if you like, because the authorities, prudential regulators, were trying to shift some of the risks outside of the banking system. But what has actually failed to happen is that regulation of the non-bank financial intermediation sector has not really kept up. And this is something that will need to be addressed.
Thanks, Claudio. And Hyun, you have something to add?
Let me add a couple of points to Mark's second question on the one-year anniversary of Russia's invasion of Ukraine. I think one of the immediate reactions to the invasion was a very sharp increase in commodity prices, especially oil, wheat, and further along, also gas, certainly later in the year. But what's happened since the autumn, I would say, from certainly the autumn, we've seen commodity prices moderate quite considerably. And what that's meant is that initial impulse to headline inflation that came from the very sharp increase in commodity prices, that has also had a chance to moderate as well. And if you recall, last year we had a very strong dollar. And since many of these commodities are actually priced in dollars, we saw a much sharper increase in commodity prices in the local currency. So if you were looking at oil prices in euros or yen, you saw a much larger increase, which then again fed into the headline. But since then, what we've found is that as the headline inflation stayed high, core inflation came up to actually meet that very high headline. And now the issue is bringing core inflation down. So this is really the focus in all the major jurisdictions. So I think as we look back, one of the episodes that really has left its mark was that very high initial spike in commodity prices, but that has really been moderating much earlier than we may have feared at that early stage.
Thanks, Hyun. And I think we have one more general question which has come into the chat before we go to the special features. That's from Sergio Tahalta of Valor, who asks if there is a case for central banks in advanced economies to raise their inflation targets.
I think the answer is a resounding no. As we have emphasized in the annual economic report, there are huge benefits of having low inflation, because when inflation is low and settles at a low level, it tends to be self-stabilizing. It tends not to be a factor which influences economic agents' decisions. And as a result of all that, it tends to support a well-functioning economy. And that is something that it would be dangerous to try and jeopardize. And raising the target would also do that because it would reduce the credibility of the central banking community.
Thanks. Claudio and Hyun, you wanted to add to that?
Just a short point. In the annual economic report last year, in chapter 2, one of the things that we highlight, quite emphatically, is this idea that once inflation gets above a certain threshold, it ceases to become something that people ignore. It becomes more salient, and then we see the correlation across categories, going up. I think one of the issues with selecting a higher inflation target is that once you have inflation going up above some threshold, and we don't know exactly where that threshold is, but certainly from the evidence, there does seem to be a threshold. If it goes above a threshold, it ceases to become something that economic, the real economic participants, ignore. It doesn't. So it's not a subject of rational inattention, as it were. It becomes salient, and then gets fed into inflation expectations, which then feeds into pricing behavior. So I think that is the crucial point. If you can keep the target at such a level that when you hit the target, it's simply not noticed. That's the ideal state of affairs. If you have a target which is too high, then even if you hit the target, it's something that people notice, and that clearly is not the outcome you want.
No, just to say that we will soon be producing a more extensive piece of work which elaborates on the chapter 2 last year. So if you're interested in these questions, I would strongly encourage you to look at it.
Thanks, Claudio. And we'll stick with the chat question for a minute because we have one from Greg Ritchie of Bloomberg about the special feature on the prudential policy. And he asks, you mentioned that some countries have been tightening prudential policy to tackle financial expansions seen during the post-pandemic recovery. What examples did you have in mind? And the second question is further prudential tightening needed, or are we tight enough now, in your view? So, Claudio.
Okay, well, first of all, actually, since the crisis, quite a number of countries have been tightening prudential standards. They include countries like New Zealand, Canada, Singapore, and the like. But also, if you don't go too far away, if you just stay within the European Union, you will see that now the level of the countercyclical capital buffer, the median level of the countercyclical capital buffer, is back to where it was before the COVID crisis, when prudential standards were relaxed or eased in order to address the big problems, the big recession and big financial disturbances. So quite a number of countries have done this. I think in the European Union, there are also plans in some countries to continue doing this. I think it's very important, and this is a key message of the special feature that this be done, because it relieves pressure on the on monetary policy to maybe have to keep interest rates lower than would otherwise be appropriate to deal with inflation, because there could be strains emerging in the financial system. This is what is typically called financial dominance. Because if you have strains in the financial system, then the central bank would have to deal with competing objectives. One is to stabilize the system, and at the same time having to keep tightening policy in order to deal with inflation. Not that this cannot be done, but clearly is more challenging than being focused very much on the task at hand, which is that of bringing inflation down.
Thanks. And I see we have a hand raised from Jonathan Wheatley of the Financial Times. Jonathan, please go ahead with your question.
Can you hear me okay?
Yes, thanks.
Great, thanks very much for taking the question. I just wanted to ask you to say a little bit more about the future path of financial conditions, I mean globally, but particularly in emerging markets, and whether this is going to be, in a sense, an aggravating factor for what many people see as a coming wave of debt workouts.
I think the question was about the future of prudential policy. I'm sorry, Jonathan, could you repeat that again?
No, it was about the future of financial conditions.
The future of financial conditions.
Yeah, and particularly how that bears on debt, both public and corporate, in well, worldwide, but particularly in developing economies where interest rates are obviously not so low.
I'll start, and maybe then Hyun will elaborate. I think that the issue of high debt, public or private, is global, although there are clearly differences across countries. And that in and of itself makes countries more vulnerable than would otherwise be the case to the vagaries or the ebbs and flows of global financial conditions. I think that what we have seen so far in the current environment is that because of stronger policy frameworks in emerging market economies, and because of preemptive action in some of them, particularly in Latin America, when it comes to monetary policy tightening, they have been faring if you like, the choppy global waters better than in the past, and this is very much good news. Now, of course, that does not mean that we're out of the woods, but it does mean that the countries are better equipped than they would have been in the past. And I think one important aspect of that being better equipped is the fact that quite a number of them have been relying on a broad set of policy tools that give them more degrees of freedom in order to deal with these competing challenges. This is what we call here at the BIS the macro-financial stability framework that includes not just monetary policy and, of course, fiscal policy, which, as I mentioned earlier, is absolutely critical when it comes to macroeconomic stability, but also micro and macroprudential policies, foreign exchange intervention, and in some cases, capital management measures, capital flow management measures, in order to better balance the different objectives and to withstand the global storms.
Hyun, did you want to come in as well?
Can I just add? Yeah. I think on emerging markets, last year was quite an instructive one in many ways. It was a year when the commodity price shock, together with the very strong dollar and high inflation around the world, did actually make both advanced and emerging economies confront some difficulties. But the emerging markets as a whole actually performed much better than one might have expected, before the event. For example, as Claudio mentioned, if you look at Brazil and Mexico, the two largest, and they're two very, very big emerging markets in the global financial markets, their exchange rates actually either stayed stable against the dollar, or in the case of Brazil, actually appreciated. And that was a great contrast with some other emerging markets, more manufacturing-based, or indeed advanced economies. And that's not to say that there were not developing economies, smaller emerging markets that really, had very severe difficulties as well, and some of them still do. But it was a kind of bifurcation, and if you compare that with the 2015-2016 episode, I think as a group, emerging markets fared much better this time. I think one of the reasons was stronger policy frameworks, as Claudio mentioned. Another one possibly was the fact that this was an episode where commodity prices rose even as the dollar strengthened. And that's a very rare combination historically. And indeed, one of the special features actually looks at that in historical context. And what that meant was that, unlike the 2015-2016 episode, when commodity prices fell very sharply as the dollar rose, this time around we had some emerging markets that are commodity exporters actually come out of the episode very well, comparatively speaking. And I think this is one of the lessons that we are taking away, especially given the special feature that's also in this issue, that you have to take account of the full configuration of financial market prices to actually gauge how financial conditions will be affected.
And just a reminder that if you do want to ask a question, you can please use the raise your hand function in WebEx, or you can type your message into a chat, or you can send us an email at press@bis.org. So I think that there's one more question in the queue. That's from Bastian of Bloomberg. Bastian, please go ahead.
Just a brief one. Thank you for taking me again. I was just wondering, we are obviously having 1 year of invasion into Ukraine today, and the upcoming March readings of inflation will be the first ones seeing that baseline effect, so comparing against a previous year month, which was already at war. So I was wondering, what do you expect will that do to inflation rates worldwide? Like, will we see a significant drop of inflation rates just due to the baseline effect, and will that after that influence monetary policy? Thank you.
Well, I don't think we have that much to add to what we said earlier. Clearly, the falling commodity prices, the base effects and the like are going to have a significant impact, are already having a significant impact, which means that the initial disinflation phase will be easier. It's likely to be easier than the second disinflation phase, which we call the last mile, precisely because these factors would have worn off. And what you would have left with is the fact that you had a period in which inflation has increased. It has increased in a persistent way. It has been eroding wages, and in some cases, it has been eroding the profit margins, depending on which particular country and sector you're looking at. And this is something that will implies that there is going to be more inertia, and that it's going to be more difficult to bring it down to, again, to travel that last mile.
Hey, thanks very much, Claudio, and thanks to everyone. Since I see no further questions, we'll wrap up now. So we appreciate your dialing in and look forward to reading your articles at 1 o'clock Basel time on Monday, and wishing you all a nice weekend in the meantime. Thanks.